Being your own boss can be great, but handling the finances can get really complicated, especially come tax time. What are some strategies that can help you keep a larger share of that pie? So the goal for today is to bring to light how taxes work for the self-employed and independent contractors. So what are some strategies that we can use to reduce or optimize those taxes? So if you're interested in this type of content, please subscribe. It helps us grow and sustain our ability to inform and educate a larger audience. So this is the Beyond Returns show, a forum about business, markets, financial planning, and more. We're here with Montebello Avenue founder Robinson Crawford. Robinson is a certified financial planner who serves over 50 clients locally and throughout the country. You're from Phoenix, right?
That's right. Phoenix, this is the time to be here. If you've never visited, come between mid-November and about mid-March. We're rocking right now. It's about 72 degrees.
My name is Gabriel Kaplan, and I'm the founder of Wealth Habits and Strategic Investors. I'm a financial advisor, and I help people invest and manage portfolios. Today's main topic, obviously, as we said, is self-employment and independent contractors. We're also going to talk about getting rich versus staying rich. Also, about those people who sat on the sidelines and waited for, for a bunch of, the pandemic. They sat on the sidelines for the pandemic. They sat on the sidelines during the election, and how that's played out for them. I think those are like the perma bears, are they called in the market. There's also the recent S1 filing for Airbnb and DoorDash. Those are interesting ones. I have some comments on that. We're also going to talk about the Apple's M1 chip and the Bitcoin rally, the current rally. So let's start with our main topic, which is taxes for the self-employed and independent contractors. So there's two big taxes, I think, that everybody needs to pay. Most people know about one, which is the income taxes, but the other one is the self-employment taxes, or Social Security taxes and Medicare taxes. So from a sole prop, LLC, partnerships, those people who have those kinds of businesses, they need to be paying the taxes from the business side and the personal side together. We're talking about self-employment taxes here. So I think the total is like 15.3%. So it's 6.2% of Social Security tax for both the employee, or both from your end and the business end. So you add those up, and the Medicare 2.9 total.
For people who are not familiar with this happens either way, whether you're an employee or self-employed. Just the method to get there is different. So self-employment tax, believe it or not, actually happens to people who are not self-employed. It just is split between your employer pays some of it and you pay some of it.
Exactly. Yeah. And then there's another hidden tax there, which is the 0.9% extra Medicare tax that gets, you have to pay it if you make above a certain amount. It's important to note, though, that the Social Security tax, the 12.4, when I'm an employee for a business, once I surpass, I think it's $137,000 now of income, I stop paying it, right? So it's like the first, 100, you pay for the first 137,400, I think it is. And I think one thing, this is a little bit of a tangent here, but one of the Biden's tax plan is to have people who make over $400,000 or more start paying that again. So there's going to be a period where the person pays for it, the first 137,000, then there's going to be a gap, and then they're going to start repaying it again, which is kind of weird. So on the self-employment side, if you're a sole prop, LLC, partnership, the burden is mostly on you. If you are an employee in a C Corp or an S Corp, it's split between the employer and the employee, right?
The burden of actually paying what is functionally self-employment tax, or AKA Social Security plus Medicare.
This question arose from I got an email from a YouTuber who said who started to make significant money online, and he was trying to figure out taxes. And I was like, okay, well, first question, do you have separate books and records? Do you have an entity for this, or is this just coming in to your bank account? So number one is coming into his bank account. So I think the first tip, or first suggestion is like, okay, if it's now become a business, let's start separating stuff.
Definitely. Not only is that important for legal reasons, bookkeeping reasons, but it's also a really good mindset shift for someone who's never thought about this before. You would think, okay, YouTube is sending me money. I'm doing all the work. It's just me. In reality, you're going to miss out and be unable to harvest a lot of the benefits associated with business ownership if you don't create an entity, have YouTube pay that entity, and then manage the taxes, the payment to yourself, all the strategies that we're probably going to get into that are involved with that.
So the first step is probably create a separate entity. You talk to your tax advisor or maybe the attorney to create an entity. It's different in every state, I can tell you that. But usually it involves talking or like going onto the website of the um, what is the website
Secretary of
usually?
State.
Secretary of State. That's right.
Mm-hmm.
And after you form the entity, I think the most obvious next step is always getting an EIN, the employee identification number on the IRS website. And to be honest, like it takes 15 minutes, but you just have to know where to click, right? So, it's weird because lawyers like sometimes tell you like, oh, I charge $150 to get that. It takes literally like 10 minutes.
Yeah.
It can be done online. And then afterwards, you're on to races. That EIN, probably YouTube will ask you for that EIN, right? Because they have to identify who they're paying to, and they use that EIN to do that. So, and then you can go to your bank and open a bank account, get a checking account, maybe apply for a business credit card, although you'll be personally liable. And then I think the most important lesson there is like, don't commingle personal and business stuff. I think the IRS has a presumption. They call it the presumption of profit, right? So you have to generate, if you're claiming losses in your business and you want to take deductions in your business, then you should be profitable. Like it should be a profit-seeking business. And they don't know if it's a profit-seeking business, but they will look within the last 5 years where 3 of those were profitable. If they weren't profitable, they're not going to come with a mind frame of like, oh, you're here for business. It's going to be more of like, well, this looks like a hobby, and hobbies, you're not really allowed to take those deductions.
That's exactly right. And that's an interesting one. The example I've heard with that is about artists, right? You think about the struggling artist who spends years honing their craft, paying little or no taxes, hopefully deducting their paint and their canvases and all the things going into that. There's an argument to be made with the IRS that they are seeking to make a profit, right? They're seeking to have their living doing that, but in the IRS's eyes, they've made some kind of safe harbor guidelines around. Yeah, if it's been 3 years of the last 5 and you haven't made a dime of profit, this is actually a hobby and not a career, which is sort of a harsh reality.
But you can fight that. I mean, it's only the presumption, right? It's like, how do you come through this? Do you come first with a presumption of a hobby, or do you come with a business? So
that's an interesting point too, and it has to do with. I was surprised by this when I started my business and started doing bookkeeping and filing taxes and stuff. That just how much is in your hands as the taxpayer. It's really the burden is on the taxpayer for reporting, right? To report what's actually happened and what's in there. Of course, it's in your best interest to report reality, right? Tax fraud, they do not. We talked about this last week. They do not take that lightly. You can go to prison for lying to the IRS. Not worth it. But it is largely a self-reported thing, so it's on you to keep track of what's happened.
I'm going to ask you, Robinson, what are the most common strategies that you have seen so far in reducing tax liabilities?
The top 2 for me are going to be considerations around using an S corp, which is a filing strategy for your LLC that you formed per our previous instructions, and the other one will be the clever use of retirement accounts. Retirement accounts as part of your business are extremely powerful. There's a lot of types. It can be confusing because there can be truly a ton. But generally, putting away money for retirement is a great way to get a big deduction, which then reduces your taxable income.
Which is your preferred retirement plan? If someone comes to you and says, "Hey, I made 120,000 last year. How I have profits I have profits of 50,000. Um, what what do I do?
Yeah, the three that are always in my toolbox I'm always considering is the solo 401k, which is very powerful because that can combine Roth, which we'll skip why that's important, but you can do Roth and you can do pre-tax. The other one is the SEP IRA. The SEP IRA has simplicity on its side. It's incredibly easy to manage, set up. You can get it done right before tax time, right? So if you make a bunch of profits in 2020 and you call a planner on March 15th of 2021 and say, help me, the SEP IRA is there, right? You can get it done quickly and
Yeah.
easily. The
And the
third one,
401k, you can't, right? You need to do it before the year end or,
exactly.
yeah.
Exactly. 401k is a bit more of a commitment, a bit more involved, some more complexity involved there. And the last one would be the defined benefit plan, especially as people are older. A defined benefit plan it's definitely the most complex, it's the hardest to use, but it's also the biggest, can be the biggest deduction in the toolbox if you make a bunch of money as a self-employed person.
Yeah, I would say, if you're up there, inching up to the close to retirement and you're making a lot of money. Um, and I think you can have a defined benefit plan and another plan. Is that true?
That's right. A combo DB 401k plan.
People, for some reason, there's this mindset they don't know if they can take certain deductions, like business expenses. I find that puzzling sometimes. You also have the other, end of the spectrum where like everything is a deduction. I'm like, no, it needs to be. I think like the IRS language is like necessary, ordinary in your trade of business. So like if you're raising pigs in a pig farm, you're not buying and selling TVs. Like that's not part of the business. Um, it needs to be ordinary in the trade of business and then necessary for the business. So like you can't have frivolous expenses.
This goes back to our initial advice on this is kind of boring. Keep records. It's like, all right, it's the most snooze-worthy advice ever. But in reality, if you want a chance at capturing all the possibilities and having the best tax outcome,
Yeah.
this is why we say this. Is because there's so many details and so many areas, from travel to your car, your personal car that you use, from business to the office inside of your house. If you dedicate that for business, there's just a bunch that if you're not keeping good records, you're not going to have a chance to go and take these.
That comes around to another area where it's just like one of the primary questions I get is like, can I deduct my home office? And the first answer I give to people is right now, as currently it stands, if you're an employee at a business and you have a home office, you likely cannot. Like that's a no. But if you're self-employed and your only area of business is your home and it's an area specifically designated for the home office that you're not using for anything else, then that area is available. You can use that for a deduction. Now, how do you calculate the deduction? There's a safe harbor. That means that the IRS gives you a way to easily do it by, using the square footage times a rate. If the room they're in is a dedicated office space that is, I don't know, 15% of the apartment, then they can use, 15% of the rent for the home office deduction, and that will go against your business profit. That comes up to another area where like you have to be profitable. You can't take the home office deduction without being profitable. Right? It makes no sense. And the IRS has special rules for companies that are profitable, but then the home office deduction makes you unprofitable. There's special rules for that. So just to be aware. The other area where I've seen people use is deferring income, so collecting income for the next year. This strategy might not work for 2021 if we have increase in taxes. You don't want to be paying more taxes on income for next year. And to be honest, I think you also have to be, most people who are self-employed are in a cash method of accounting. So that means that their accounting is based on money that has really come in versus money that has come out, as opposed to like big corporations are in something called accrual method, which is another conversation, a very boring conversation that I don't want to get into.
Yep. So you're talking about deferring revenue. So if you've got a customer, it's mid-November now, and you've got a customer and they want to sign you on for you're doing consulting, you're doing some project for them. If you're on a cash basis, what you can do, and you think you have a really high tax year this year. So let's say you live in New York and next year you're moving to Las Vegas with no state income tax, and there's other reasons why. Maybe you're getting married and your tax bracket goes down, right? Other kind of big life events happening. You could ask that customer, there's a risk, of course, that they don't pay, to defer paying you the first portion of that from December 15th to January 15th, right? And that would kick that revenue from one tax year into another. That's one of the flexibilities and tools in your
Yeah.
toolbox.
So if you liked what you've heard so far, please subscribe. Feel free to ask any questions again in the comments section. Let's resume with our agenda. So the next topic of conversation is getting rich versus staying rich.
Yes, I brought this one up. I brought it to the table. I'm curious, Gabe, has any client or anyone you know ever asked about the difference in these two? Has this been a topic of conversation for you before in your professional life?
I think no, but implicitly they all ask me like, hey, I don't want to, mostly around retirement. I don't want to run out of money. I think that's another way of saying like, I kind of want to have enough assets. And I always come back to the same thing, like rule number one, spend less than you earn.
Let me start with this point. It is unlikely that a professional advisor of any sort is going to be the reason that you become rich, if that makes sense. So the tools in the toolbox of the professional advisory world, I don't think are built for truly getting you rich. And of course, I'm open to you pushing back on that.
I think the only aspect is of getting rich is the moment where maybe you have a life event that will get you there. A planner can help you optimize it, right? But yeah, we're not here to get you rich. We're here to help you stay rich and probably help you to probably get richer if you have that
Right.
life event.
Right. The big jumps, though. There's people who have, of course, studied this. The two key ingredients to getting rich, if they're going to happen, would be one, leverage, meaning either borrowing a bunch of money and using that in a very useful way, or other types of leverage, or concentration being the other one. So most of the wealth, I don't have numbers on this, but most people I think who become independently wealthy in the United States do so by founding a business, right?
Mm.
And it's a little counterintuitive, but founding a business is just concentration, right? All of your wealth is in one place. You make one really big bet, and when that pays off, that concentration is what happened.
Yeah, and I think it's also you talk about leverage. I think there's two types of leverage, right? In this case, it's capital leverage and human leverage. When you have human leverage, that means you can hire a lot of people for a specific compensation, and you're charging clients a little bit higher. A good example of capital leverage, which isn't using partners, it's just mortgage, right? You're taking out a mortgage on a house, but you're only putting 20% down. That's you're using 5 times the capital to get. And if that house goes up in price, let's say 10%, your return is much higher, right? So if the house cost you 20, if the house cost 100,000, it went up over a decade, it went up 20%, so 20,000, and you only put down 20,000, you made 100% return.
That's a great example, and one that people don't think about, as people don't consider that leverage for some reason, or I don't know. Most people, especially now with mortgages really low, don't so much worry about that being leverage. But I like to bring up the example. I'm like, okay, if you came to me and said, all right, you want to build a portfolio of stocks. We love this portfolio, and it's all these brands we love. And if I was like, hey, I know you only have $50,000 to do this. Let's go to this bank and borrow another 150,000, and then we can buy 200,000 of stocks. They'd be like, are you insane? Like, what's wrong with you?
Yeah.
Something's off in your head. But
Yeah.
with mortgages, or with houses, it's totally expected.
Yeah, nobody has a second thought about that. Let's jump on this topic, which is people who chose to sit on the sidelines during the election and the pandemic. Actually, people who sold maybe things pretty early on in the pandemic and never got back in because they thought the pandemic would ravage the world for a year and a half. Um, there was, I call those the perma bears because they are these people who have sat out since 2008, and it's been 12 years, and they were right in, they have, there was maybe 2 years in that time frame between 2012 and 2020 where the returns looked like they were going to go into, bear market, but they never did. And the returns have been spectacular since for those 8 years. And those people have sat on the sidelines and they've really suffered a large opportunity cost here. My philosophy is always like stay in the market as long as you can, feel comfortable being in the market, but you have to stay in the market. Like it's a must. It's like the lesson maybe learn from this. And those people who were right at the beginning of pandemic, it was a very, very short time they were right because the market rebounded very quickly.
This topic makes me think of people, individual people, and their own psychological scars, right? And they are scars. If you had a significant portfolio going into the great financial crisis and you thought it was all blue chip stocks and you were safe in a lot of ways, and you had AAA rated mortgage bonds and they looked safe from every direction, the experience of going through that really does create scars. So I'm not saying everyone who's chosen to sit on the sidelines necessarily has had an experience like that, but that tends to be a pattern of that. Like the story here is that you suffered is if you made this choice, right? You suffered for the choice to decide when to get in and when to get out on a discretionary basis. So um, I brought it up only because I have heard it a lot. No, I'd like to see how things shake out and feel like there's more stability. Um, the problem is we don't know that there's a very small portion of days in the market that contribute to you getting these even average returns, right? Just capturing average returns in the market necessitates you being participating in these few days that are massive rallies, and a lot of those have been around this election. So that choice to sit out on the sidelines, there's no telling how much missed compounding that could result in.
I'm going to actually link to probably some reading material in the description. But the thing is, it's very clear here. If you look at a longer term basis, and the market has returned X percentage over the years, you've heard of the fat tail, right? Which is essentially that the returns they don't follow normal distribution perfectly. So like to get that average return, you really need to be in the market long term also, because some of the returns are very high in normal in rare years, right? And that contributes to that average being where it is. If you take out those high returns, you get a very poor return outcome. You have to be able to visualize. I feel like this is the one aspect where maybe some visualization helps to show people, to those people who've been scarred, saying like, this is it, it's normal. These events do happen, but in the long run, you will likely be okay. The next topic is the recent S1 filings of Airbnb and DoorDash. And I think I mentioned this to you before the show, but I did not read the DoorDash one yet. I read the Airbnb and I have, my comments on it, and it doesn't, I don't get a good feeling from it. Specifically when I'm comparing it to the IPO of what used to be called Priceline, now it's called Booking Holdings. I see them also in like the travel area. Uh, the difference is, I guess, one of them is a brand, which is Airbnb, and the other one was just a intermediary. So the capital, for some reason, it seems that the margins in Priceline, what's Booking Holdings now, was much higher. The growth was much higher. Just a better company, and the valuation, after the dot-com bust, was very, very low compared to where Airbnb is, which is a high valuation. The margins aren't great. And I don't know if the growth is there because we're in a pandemic right now.
I didn't read this. This sounds scary. It makes me think of those. I think some videos leaked that maybe weren't supposed to be leaked of the Airbnb CEO earlier in this pandemic, looking very disheveled and giving maybe doing layoffs or something over
Yeah.
video. it looked just really rough.
If you look at the stock market, specifically in travel and leisure, prices have come down dramatically for those companies. So it shouldn't be expected that. I mean, it should be expected that Airbnb's pricing will actually come down also.
Agreed. Agreed. I actually have read that that's part of their IPO pitch right now, is that getting in on this IPO is getting Airbnb at a discount to a lot of
Oh yeah,
sophisticated private investors that invested a year or 2 or 3 years ago, and you're actually going to get a better price, which is
yeah. You just to hold out for the long run and hope they can execute on, the recovery.
yep.
What about DoorDash? How do you feel about that one? Have you read? Did you see any of the pitches?
I did. I did. I think DoorDash is a really interesting one. The headline number that's gone around is they have increased their portion of the food delivery ecosystem um, market share this year. So they've executed really well through COVID. It's kind of the mirror image of Airbnb. They're up to, so obviously food delivery increased in volume dramatically throughout COVID,
Yeah.
and they also got up to about 50% market share, which is pretty impressive. And a lot of people that I've talked to who are users of various food delivery apps were surprised to hear that. I don't think that I don't think it's the perception that they have like the highest quality business or the most restaurants on the platform or anything, but they have 50% market share. So executionally, they have to be doing something right there.
I haven't used DoorDash ever since I moved to the suburbs. I've been cooking way more.
Good for you.
So
Saving up for that mortgage.
yeah, exactly.
Yeah, it's not cheap. It's not cheap to use these delivery services, and it is quite like the gross profits are quite good for these companies that do these. Right, they're
Yeah,
outsourcing the labor. It's a software
yeah.
network effect service thing.
I mean, I've used Instacart for food delivery, and also like you pay a premium for having someone pick the
Oh
food
yeah.
and deliver it. It's also for some reason like the Costco, which is the store I love. It's like my temple. Um, Hail the gods of Costco. I mean, it's expensive to go there. I would say from a time perspective, like if you value your time over the weekend of a certain dollar amount, sometimes even the delivery cost like is worth it. I probably say landscaping, it's outsourced here. I found a pretty good one to outsource it. I will say though that I do the leaf blowing sometimes.
It's kind of
Is it?
satisfying, isn't it?
Yeah.
Yeah.
And my son running around me, 2-year-old, like super excited to see this machine working. One topic I wanted to talk about was the Apple M1 chip. It's what I've read some comments about it, and they say that there's a vast improvement between the relationship of computational output and power consumption. So while the M1 chip might not be as powerful as like the high end chips, they're still way more efficient, and they're just gonna, this was the first release and they haven't moved up market yet, Apple. But the moment they move up market with the same power, computational output over power consumption ratio, you could see some really interesting results. What that is, it's actually pretty scary if you're Intel, right, or Intel or AMD. It means that you're pretty behind in development, and to me, the big question is like that there isn't any new technologies that they're using. It's more about architecture or chip architecture inside, and that's something that I would say is actually IP. My fear is that you will have this temporary like discrepancy between performance and price in Apple's favor in the next, maybe 5 to 10 years. If you look at it translating into stock, and if your thesis was that Apple was expensive in the past, you might want to rethink that.
This is really interesting news. Does this mean functionally? So, like, when you think about the possibilities for this, which you just sort of laid out, right? So, Apple maybe has some chip architecture that's a big deal improved from Intel or AMD or Nvidia or whoever it is. Does this mean in the future that it would be plausible to imagine that Apple would be selling semiconductors, chips, whatever this thing is, into data centers, for example? I just don't know if this particular chip has any like relevance in that world. Semiconductors are an interesting world. You can correct me if I'm wrong. I believe they're like highly cyclical, right? The
Yeah, they are.
semiconductors a very
Yeah,
boom and bust
yeah.
industry in terms of their equities.
They require a big investment for. If you look at the so who manufactures most of Apple's semiconductors? I think it's like Taiwan.
TSMC, Taiwan
Yeah,
Semi.
yeah. So they are like they create big fabs. So those are the companies that take orders, whatever orders from anybody of chips, and they manufacture them. But Apple's behind there designing them and making sure the architecture fits in for the needs that they have, right? So the needs that they have, they're creating a chip that's highly efficient for their purposes. Now these chips that they have developed are very they're very specific towards low power consumption, and that reduces the need for more fans, so they can make it thinner, and that reduces just because it reduces power consumption, it increases the battery life. So then you can reduce the size of the battery if you want to maintain the same kind of battery life. So there's all kinds of these secondary benefits in pricing. The last thing I want to talk about is Bitcoin rally. It's at like 18,000 something last I saw. The high in 2017, in December 2017, I think it was around like 19,345. Whenever the Bitcoin price reaches these levels, I start to get inbound messages saying like, "Oh, what do you think about this? What's your opinion?" Obviously, I'm not an expert in Bitcoins, but it seems to me, based on the properties, that this is an area where you store value. It's not going to create value. It's more like a storage of value. It seems to me it's very similar to gold in that aspect. It just happens to be, what gold is for my, grandfather or father, Bitcoin is for our generation in terms of storage of value. You can use it in certain aspects in areas where they take Bitcoin, but it's not very.
Bitcoin still has the on ramp to get the average person to use it. I still think it's difficult and clunky to use. There's obviously companies working very hard to make that easier. Coinbase. I think the Coinbase IPO will be a bonkers, like wildly speculative, huge mania when that happens. I think that is coming. But the Bitcoin rally right now, the main thing I think is interesting compared to 3 years ago is that it's not as big of a conversation point. I mean, obviously we're
Yeah.
bringing it up here, but I'm not getting the inbounds. I'm not getting the text from friends who are maniacally, getting it as much as they can, as fast as they can, which I think is an interesting juxtaposition, right? It doesn't feel to me, and maybe I'm wrong about this, but it doesn't feel as much of a mania or a bubble as the last one did.
Yeah. The other one was like clear. Everyone was talking about it. It's like, this is a bubble. I'm buying more.
Right. Yeah. Yeah. Self-reinforcing bubble. I feel like that's a positive, all things equal, that we're not such in a fever pitch of speculative mania right now. I think that's probably healthy for the Bitcoin project, which I ultimately view as a kind of a binary outcome. Either this store of value story that you just described is functional and it works and people can agree on it and work it into whether it functions as a like a hard asset, a reserve of sorts, or not. I view that as binary. And I think it's probably worth a lot of money if it does function, but I couldn't assign a probability as to whether or not it will work or totally fail. And if it fails, it's worthless, right? It's fake internet money.
And I've thought about this, and I don't have an answer yet. Is it worth to put, like, if you want to create a completely diversified portfolio, and you have right now in that portfolio, let's say you have 5% gold, would you actually sell some gold to put Bitcoin in there?
Not investment advice. Yes, I would personally.
Yeah, personally, yeah.
I mean, all else equal. Yes.
I would agree with you because diversification is diversification.
Yeah, it's the only free lunch. Over long enough time periods against all government issued currencies, the trend line of those currencies against gold just trends asymptotically towards zero, right? Like of course, there's dips in between, but eventually they converge where the gold is worth much, much more than the currency. Um, if Bitcoin can find its way into that reserve conversation and then be accessible for big investors, for institutions, pensions, etc., then it has a chance. It's still small, right? It's under, it's what, 300 billion, something like that. So it's like not even a mega cap company, right? It's like a large cap.
Also, I think that the prices there's one anchor to the price of Bitcoin, which is the mining cost.
Mm-hmm.
I just don't know where it is right now.
Yeah, that depends on. I think has to do a lot with
energy,
your power
right?
costs. Yeah. So if you, I know they've set up Bitcoin mines very close to electric dams where they're harvesting the excess, right? So the hydroelectric dam sells the power to the grid, and the grid only needs so much, and there's excess. And at least as of now, we are not storing excess in like batteries, right?
Yeah.
So the Bitcoin mine is there hoovering up cheap excess power.
Doesn't California sometimes pay someone to take their electricity?
I don't know.
I thought I heard that like in the middle of the summer or something, they have when solar or like wind actually produces too much power, they actually have to pay like Nevada, their border states to take
it. Wow.
To take it, right? So they're paying them to absorb the electricity into their grids. I was just saying, like, you just set up like some, in Nevada, you can set up some Hungary, some chipsets that mine Bitcoin.
Grab some M1 chips, put it to work.
And you can get paid to take the electricity, and then you get paid to mine it. So this is all what we have for today. I mean, I think this is, our next video, hopefully or next podcast or whatever you want to call this, will come out in a week from now. We try to post these on a weekly basis. But yeah, it was great to have you. At some point, I think we should probably bring on some guests.
Of course.
If you'd like that.
Yeah, thanks for having me, man. It's fun as always.
Yeah, good. Talk to you soon.